glad to be here. It's always fun to be the webinar presenter. Wish I could see you, but I hope you're all comfortable and ready to go through an hour of good stuff. I'm Joe Christon. I'm a tax partner housed in the Des Moines office and also part of the Eide Bailly National Tax Office. And I am going to start, since this is what the hot news item is, on the Inflation Act changes. The Inflation Act was originally the Build Back Better Act, enacted a year ago, and it had a whole lot of potentially scary tax provisions. And we talked a little bit about this last year. A lot of people were planning around these things, thinking, oh, this is going to happen in 2022. We better do all this stuff. And then as things turned out, nothing happened before the end of 22. And finally, here we are in August, and a version of this is passed. And of all the scary provisions that were in Build Back Better, the final product, the so-called Inflation Reduction Act, has only 3 of the significant tax changes that were in Build Back Better: a global minimum tax based on financial statement income, an increased IRS enforcement budget and budget for other matters, and a stock buyback excise tax for stock redemptions of public companies. So for most people, those items aren't going to have a big impact. If you have a public company, it'll matter. If you have a very large company, it'll matter. But for the most part, these changes will not be affecting most clients. Only a few hundred clients in the entire country likely to be affected directly by the book income tax. And the stock buyback tax has broader application, but you still have to be a public company. So do we have to worry about tax changes? Well, there are still changes we need to be thinking about. Remember that in 2026, the top individual rate under current law returns to 39.6%. In fact, a whole bunch of the 2017 Act tax changes go away. The old itemized deduction rules return. The Section 199A qualified business income deduction expires, and estate tax lifetime exclusion returns to pre-2018 levels index. So right now it's about 12 million. It'll go back down to about 6 million per person for a lifetime exclusion, meaning that there's still a need to consider future changes in your tax planning. Will any of these changes be allowed to take effect? Well, you have to be able to successfully predict who the president will be and who what the composition of Congress will be when these things are due to expire. And I don't think any of us are smart or brave enough to bet a lot of money on anything in particular. Okay, with that update, now we'll talk a little bit more about some business planning things. We're going to emphasize business tax planning for the beginning of this section, and then we're going to finish up with discussion of personal tax planning. So when you're talking about business planning, you need to start at the beginning. You need to choose your weapon. And by weapon, I mean entity. Do you want to be a C corporation, or do you want to be some sort of pass-through entity? C corporations do have their advantages, starting with the flat 21% tax rate under current law, and that is not going to automatically expire in 2026. And there's a lot of attraction to that flat rate as you go along. As anybody who has a pass-through entity, a partnership, or an S corporation with a lot of owners knows, it's nice that shareholders can be oblivious to C corporation tax situation in their own personal planning. C corporations pay their own tax, and the shareholders are only affected by C corporation tax issues when they get dividends or when they sell their shares. Otherwise, they can be happily ignorant of the tax picture of the corporation they own. Finally, there's another big advantage to C corporations, particularly in the startup phase, and that's Section 1202 opportunities. Section 1202 can provide, in the right situation, a 100% gain exclusion on the sale by owners of so-called qualified small business stock. A qualified small business is a C corporation that engages in a so-called qualified business that has never had gross receipts exceeding $50 million before the qualified stock is issued. What's a qualified business? Well, it's defined by exclusion. You're a qualified business unless you're a business involving the performances of services in health, law, engineering, architecture, accounting, actuarial science, performing arts, basically the things that we're talking about in 199A. Also, retail trades generally don't qualify, farms don't qualify under the qualified business exclusion. Some other conditions apply to exclude the gain from qualified small business stock. Stock has to be held for at least 5 years. Stock must be acquired at original issuance. And the gain exclusion is limited to the greater of 10 million or 10 times basis. So there are upsides to being a C corporation, but there are a lot of significant downsides that have generally kept people from reverting to the C corporation form after being an S corporation or a partnership. These include the double taxation. All C corporation income is taxed twice, one way or another. If it's distributed as dividends, it's taxed as taxable dividends. If you sell the stock to cash out, you don't get any increase in basis for accumulated earnings left in the C corporation. And so that gain is taxed in addition to the tax that the C corporation has been paying all along. Also, the status of Section 1202 is a little bit uncertain. It was nearly scaled back a couple of years ago, and so it could happen again. And so that's the 100% exclusion is definitely not something that would necessarily survive another major new tax overhaul. And finally, the status of rates. Right now, corporations have a 21% flat rate, but pretty much every proposal by the Democrats and some by Republicans call for an increase in the corporate tax rate to pay for one thing or another. So we have no way to be certain that the C corporation rates will stay at 21%. And if it doesn't, that worsens the whole double tax problem. Okay, now we're going to move on to another issue. I'm going to talk about whether it makes sense to elect to pay taxes. You're saying, why would I do a thing like that? Well, it's really more electing to have somebody pay taxes on your behalf, as we'll see here. Most states have now enacted pass-through entity taxes, either optional or mandatory, as a tool to work around the current $10,000 individual cap on itemized deductions for state and local taxes. And this handy chart, which is also available at the AICPA website, and we'd be happy to give it to you along with the other slides, shows which states have enacted or proposed pass-through entity taxes. Iowa had one proposed last session in its legislature. It did not advance. but right now, a majority of states have some sort of pass-through entity tax. And most of these are elective rather than mandatory. Here's how it works and why it can be attractive. Let's assume we have an interest, a taxpayer who owns an interest in an S corporation. This taxpayer receives a K-1 showing $1 million of pre-tax income before considering any entity tax. The entity elects to pay tax and pays a $50,000 entity tax to state B, a non-resident state, to the taxpayer who owns the S corporation. All income of the company is apportionable to state B. Taxpayer lives in state A, which requires its residents to report 100% of their K-1 income on the state return. The state A rate and the state B rate are the same. Each state requires an add back to income of the entity deduction for state taxes. And we're assuming all income is eligible for the 199A QBI deduction. So the effective federal tax rate here is 29.6%. So the federal benefit works out to be $14,800 for getting this deducted at the entity level. In other words, the K-1 on the federal return is reduced by the $50,000 tax. And so the individual pays that much less tax than they would. If the entity if state A gives credit for taxes paid to other states to the tax paid to state B, then there is no additional state tax cost. And so the taxpayer is ahead by $14,800. However, if state A does not give a credit for the entity tax paid on the owner's individual return, then it's a disaster because you paid $50,000 tax to state A, and then the owner still has to pay tax to state B because they don't get, vice versa. They pay $50,000 to state B, and they also have to pay the full tax to state A, and they're out $50,000. There are some states that do not allow a credit for taxes paid to other states that have entity taxes on the individual's return if the entity pays the tax. So Maine is probably the most notorious example, but Virginia has problems. Most states have a reciprocal rule that allows it if the other state allows it, but the scope of those can be a little bit confusing, and so it's something you need to be very careful about. If you do elect to pay the entity tax, what does it look like on the K-1? The amount of tax paid by the entity will show up as a so-called Box 1 expense, not separately stated. In other words, it's going to reduce the top line income shown on the K-1. This has some weird results. For example, a lot of K-1s, like investment partnerships, might not have any line 1 income. So that'll show up as a $50,000 loss. If it's a true investment partnership, that loss is not passive under the passive loss rules, so that loss will be deductible. If it's a trade or business that rather than an investment partnership, that entity tax will be a passive or non-passive deduction based on the passive or non-passive status of each owner. Okay, how are the elections made to pay these taxes? It varies state by state. Some you can wait until the due date of the entity return to make your election. Others require you to take action during the 2022 year. And so, for example, if you are electing in California and your entity is going to have income in the year, you're already required to have made an estimated tax payment on your 2022 taxes. So that's something that if you're really interested in and it's something that matters to you, you need to start looking at this right now. Other deadlines come later this year, but So don't just assume that you can wait until the return due date to make this call. Another thing to watch out for is the timing of these. Even if you wait until next year to make the election, you might have waited too long to get a deduction on the 2022 return. That's because the normal accounting method rules continue to apply in determining a deduction for taxes paid by the entity. If you're a cash basis if your entity is a cash basis taxpayer, then you've got to pay that tax by the end of the year. And if you haven't made that election to pay that tax by the end of the year, you might have a problem. Accrual basis taxpayers are required to meet on all events and economic performance tests for the tax. And it's not clear always when that is met, especially if you wait until the following year to make the election to pay the entity tax. If you wait until 2023 to make a 2022 entity tax election, you might not have met the all events test. If you want more details on this, Andrea Mao of our National Tax Office is the person to contact. She is all over this. Okay, I hope you're still interested, because now we're going to talk about interest deductions. Something to be aware of as we go into year-end planning season is that the interest limitations on business interest expense that were enacted in 2017 really begin to bite in 2022, tax years beginning in 2022. These rules limit interest deductions to 30% of the taxpayer's adjusted taxable income for the year. Before 2022, that adjusted taxable income was computed without deducting depreciation, amortization, and depletion. It was basically EBITDA. But starting in 2022, you have to deduct depreciation, amortization, and depletion before you determine that 30% cap on interest expense. And that can have real implications for a lot of taxpayers. And it's going to apply, and so as a result, these so-called Section 163J limits will apply to a lot broader range of taxpayers in 2022 than they have in the past few years. Not all interest is covered by this. For example, vehicle floor plan interest is excluded from these limits. Farm interest and real estate interest can be excluded at the taxpayer's option at a price of reduced depreciation deductions. However, if you make that election is permanent and you're stuck with it. So something to keep in mind as you go. There's also an exclusion for smaller taxpayers that lets a lot of people out from this item. The Tax Cuts and Jobs Act, which enacted these limits, set a $25 million average gross receipts cap on where this would apply. In other words, if your average gross receipts for the prior 3 years is under 25 million, then you are not subject to this. $25 million is indexed for inflation. It's the same threshold that applies for requirements for accrual accounting, inventory capitalization, long-term contract accounting rules. The index figure for 2022 is 27 million. But before you just sort of say, well, I'm fine, this doesn't matter, you really need to take a hard look at whether your business is really small for this purpose. The test for smallness is applied on a controlled basis, group basis. The gross receipts of businesses under common control need to be aggregated to see whether you pass this gross receipts test. And the reason why they do this is, pretty intuitive. There's a lot of opportunities to break your business into smaller businesses to avoid running into this cap. And this prevents people from doing this. And so everything is applied on a control group basis. Another item that a lot of people don't take into account is that K1 recipients have to include their share of the partnership or S corporation's gross receipts, rather than that entity's net income in determining their own gross receipts. There are a lot of situations that apply that can push taxpayers over these limits. And these limits can apply to individuals as well as to business entities. So a taxpayer who has a relatively small net income still can have a lot of gross receipts coming through on a K1, depending on how that business is performing. So something that taxpayers really need to keep an eye on and not take for granted as they do their year-end tax planning. Okay, now we're going to move on to basically fixed asset planning, buying things, taking credits. As you go into year-end tax planning, as long as bonus depreciation is in place, buying fixed assets can be a very useful tool to reduce your taxable income. Keeping in mind, of course, now that 163J applies the deduction for interest limits after taking depreciation deductions. If you want to get these depreciation deductions for assets purchased by year end, remember that those assets have to be placed in service by year end, regardless of when ordered or paid for. Placed in service means on the floor, ready to go, not in a box on the loading dock, not in a FedEx truck somewhere, not on order for future delivery. They have to be in service, ready to go by the end of the tax year. Fixed asset additions. Consider, as you look at it, whether you might be able to get bonus or shorter live depreciation for your construction and remodeling costs. There are a lot of costs that you might think of as building costs that are actually currently deductible or deductible over shorter lives. Consider the use of safe harbors for expensing smaller asset purchases. The so-called repair regulations issued a few years ago give you a lot of leeway when you're replacing assets like air conditioners and so on to expense rather than capitalize expenses. And a lot of remodeling and construction expenses, even if they wouldn't otherwise qualify for expenses of anything other than as a building, can still be currently deducted under the energy efficiency incentives of Section 179D. If you have any significant construction or remodeling costs during the year, it's a good idea to contact Eide Bailly Fixed Asset Services. Our fixed asset services team does a great job of identifying these costs, and they more than pay for themselves several times over by moving depreciation into the current year instead of, say, between now and 39 years from now. Okay. Now we're going to talk a little bit about the status of research credits and deductions. Research credits were not affected by the Inflation Reduction Act. However, a delayed 2017 Act provision is scheduled to affect deduction for research costs in tax years beginning this year. The new rules require those expenses to be capitalized and amortized over a period of 5 years rather than being deducted currently. A major and important change, one that's going to increase a lot of taxpayers' taxable income. These expenses will still qualify currently for the research credit, assuming they qualify otherwise, but the deduction will have to be spread out. We do expect a flurry of year-end lame duck legislation near the end of the year. It is possible that the full current deduction will be retroactively restored for 2022 as part of these changes. There's certainly a strong legislative push for that, but there's no guarantees in Congress. And so, especially in a lame duck session, especially with the current partisan situation. So something that you need to be aware of as you go into your year-end tax planning. Also, for your planning, you need to keep in mind that employer retention credits are a thing, not for the current year, but for 2020 and 2021. We still continue to find a lot of taxpayers who have failed to take advantage of this when they've been eligible for it. Up to $5,000 per employee in 2020, up to $7,000 per employee per quarter for 2021. Generally requires declines in gross receipts, but sometimes can be available based on shutdowns, but by no means always. It's available for nonprofits as well as for businesses. There are a lot of so-called employee retention credit mills that are just working the phones, calling businesses, saying, hey, you qualify, you automatically get this. That's not necessarily true. Not all businesses do qualify. But if you think you might, I strongly encourage you to contact Eide Bailey's Jim Donovan for further information. Our team has recovered a lot of employee retention credits for businesses over the last year and continue to do so. As you do your tax planning for this year, if you have exports in your business, you need to be thinking about whether an interest charge DISC, Domestic International Sales Corporation, can help you. The advantage of this, without going through all the technical details, is you can convert ordinary export income to lower tax dividend income by setting up one of these things. And if this income qualifies for the QBI, the effect is to lower your tax rate on that income from 29.6% to 20% at the federal level. And if you're if you don't qualify for the QBI, you can be lowering your tax effective rate from 37% to 20%. What is the IC DISC? It's a paper corporation that is set up under rules enacted a long time ago as an export incentive. There are IRS rules that allow you to automatically determine a commission on that's paid to the IC DISC on export sales. And, it's not a controversial thing. It's not a gray area. The computation of these things is relatively straightforward. The exporter deducts the so-called commission to the IC DISC, which is a separate entity. And then the IC DISC can make a distribution to its owners that qualify as qualified dividends taxable at 20%. When it's all done, basically what you're doing is creating deductible dividends if you set this up right. So something that you need to do, the sooner you set it up during the taxable year, the more exports can qualify. So good reason to contact your Eide Bailey International Tax representative. There are some other important foreign tax issues that are effective this year. New proposed Treasury rules threaten to reduce the ability to take a credit against U.S. taxes for a lot of foreign taxes that have been historically eligible. Brazilian income is probably going to be the hardest hit by this, but Brazil is not the only country that's going to find its taxes that would no longer qualify for a U.S. foreign tax credit. And that can be a very expensive thing for taxpayers with income producing investments in Brazil or other countries. So something to keep an eye on, and another reason to stay in touch with your Eide Bailly international tax representative. Also, if you started doing business offshore, you need to stay on top of compliance and plan on that. There are a lot of international compliance forms that have to be filed, with penalties starting at $10,000 for being as little as a day late with filing and going up from there. Among the items that will trigger these filings are certain investments in offshore corporations, control of offshore partnerships, ownership of foreign disregarded entities, in other words, a wholly owned foreign LLC. Even if it's disregarded for U.S. tax purposes, you still have to make this disclosure. Certain foreign remittances to the U.S. can trigger these things. For example, remittances from a foreign trust, gifts from a foreign donor can trigger these filing requirements. Ownership or signature authority over foreign financial accounts can trigger compliance issues. And that can be a really awkward thing, because you might, for example, have a company that has a foreign bank account for the usual reasons you would have a bank account for an operating business overseas. And you might have a U.S. person somewhere down the chain of command of the U.S. entity with a signature authority. That person, even though they have no ownership of that account, still has to file a so-called FBAR Form 114. Finally, ownership of certain foreign assets triggers a special filing requirement. So if you have any of these issues in your business or personally, definitely get in touch with an Eide Bailly representative and make sure you're not ringing up $10,000 penalties as you go. Your contact there to start is Shannon Lamone. She heads the Eide Bailly National Tax Office International Group, does an awesome job, and she can answer your questions and get you help. Okay, now back to business planning. Watch out for lost losses. I know that's a lot to wrap one's head around, so we'll just go right into it. We have, if at the individual level, 4 loss deduction hurdles. You have to have enough basis to take the loss. This is particularly applicable to S corporation and partnership investments. Not only do you have to have basis, but that basis has to be, quote, at risk under the so-called at-risk rules of the tax law. If you clear those first 2 hurdles, then you have to clear the passive loss hurdle. Your loss can't be passive if you want to deduct it. Now you can clear all 3 of these hurdles and still trip over another hurdle no matter what you do, and that's the individual business loss limits that were enacted in 2017 and took effect in 2021. Basis. This is a good time to start monitoring your basis to ensure that deductions are available to S corporation shareholders and to partners. Since these basis determinations are made at the end of the year, current distributions during the year can affect whether loss deductions are available to shareholders. So one of the tools that you have in trying to maximize the ability to use current year losses is to consider limiting distributions so that you don't reduce basis more than necessary. The at-risk rules target so-called non-recourse debt. These were enacted in the 1970s to shut down that era's tax shelters with a built-in loophole for third-party debt of real estate activities, which generally are exempted from these at-risk rules, but not other businesses. And otherwise, if the debtor is not on the hook for the debt, it tends to be non-recourse and may not be available to allow a deduction under the at-risk rules. One common trap that people run into is related party financing. They might think that they're at risk, and under most definitions of the rule or of the term at risk, they are. But if you're borrowing from somebody that has an interest in the activity that you're investing in, then that debt is generally not going to be at risk, regardless of how much at risk you are economically. So, for example, if you are buying into a business where you work and you borrow money from that business to finance it, that borrowing probably will not be at risk because of the at-risk rules related party provision. Passive losses. Okay, you're at risk and you've got plenty of basis, you've got losses. Are they passive? Well, these are the 1986 anti-tax shelter rules that have been around now for a long time, and they're generally based on the amount of time that is spent by the taxpayer on the activity. What makes an activity non-passive for a year? If you spend more than 500 hours working in the activity as a participant in the activity rather than an investor, then you're non-passive. If you have multiple activities where you spend 100 hours or more each and they add up to more than 500, you're non-passive. If you spend 100 hours in an activity during the year and more than anyone else, then you are materially participating. There's a substantially all participation exemption. There's a general facts and circumstances rule that you can try to fall back on if you fail the hours test. And then there are a couple sort of mulligans. One is the last 5 years rule. If you have materially participated under the hours test in a business in 5 of the last 10 years, you are considered to materially participate in the current year. If you are a retired farmer who materially participated in 5 of the 8 years of the farm activity prior to taking Social Security, retirement, or disability benefits, you are always considered to materially participate in that farming activity. So you're not passive, you're at risk, you got plenty of basis. Now there's a new limit that started to bite last year, and that's the so-called 461L business loss limits. Limits are $250,000 for single filers and $500,000 for joint filers, adjusted for post-2018 inflation, which means $270,000 and $540,000 this year. So that means no matter how on the hook you are, no matter how hard you're working, no matter how much basis you have, your total business losses for the year net cannot exceed these limits. Here's a nice example. Emma, a single taxpayer, owns an S corporation. She has $500,000 in losses from her S corporation, pass all the basis, at risk, passive tests. She draws a $300,000 salary from the corporation and has $300,000 in other income. Her income before itemized deductions turns out to be $330,000. Why? Well, she's got her salary and her other income of $600,000. She has a $500,000 S corporation loss, so you'd think, oh, okay, she'd have $100,000 net income. However, $230,000 of that is excess because it exceeds the current year $270,000 excess loss limit. So she ends up with taxable income before itemized deductions of $230,000. This excess is treated as a net operating loss carry forward to the next year for federal purposes. There are some strange state rules. For example, in Iowa, that $230,000 excess just goes away under current law. So something to watch out for. Planning idea here, you notice that her salary was $300,000, which meant that it was $300,000 of her $500,000 S corporation loss. By knocking that salary down, she could have reduced her excess loss and reduced her taxable income. So she's basically punished for taking a nice salary for this. So one other factor to keep in mind in your year-end tax planning for pass-through entities. Okay, you can't take it with you. Okay. As we discussed earlier, there are a number of tax law changes that are going to be kicking in 2026 absent congressional action. Right now, we have a lifetime exemption of $12,060,000 and a $15,000 per donor exclusion. That $12,006,000 goes away in 2026. But if you make your gifts now under that $12,006,000 thing, even if the exclusion goes back to a lesser number, the gifts that you make under the current exclusion still count. They don't get clawed back. And so if you are in the fortunate position of being affected by that 12 million versus 6 million exclusion, there's a lot of good reasons to plan to use that excess before 2026. And you ought to be talking to your estate planner now. You should also, if you're in a position where you're likely to have estate tax, you should also always be using your annual exclusion to the extent that you have donees that you plan to have get this money anyway. If you don't use that $15,000 donation for a year, it's lost forever. And, when you consider multiple beneficiaries, multiple years, that 15,000 can add up to a much bigger number over the years. States, one of the things that can be a little bit demoralizing about preparing tax returns is you work hard, you finally get the federal tax return to work, and you're pretty proud of yourself, and then you realize, oh, I still have a couple dozen state returns to do. State taxes are becoming a much bigger part of tax planning as a result of both state aggression in trying to collect taxes from out-of-state businesses and the Wayfair decision that has enacted new thresholds. While the Wayfair decision technically applied only to sales taxes, you're seeing a lot of the concepts of Wayfair beginning to be applied on income taxes, particularly so-called factor nexus. In other words, staying your taxable in a state just based on how much your sales are in a state. The Wayfair decision said basically out-of-state vendors have to collect sales tax in a state if their sales exceed a certain annual threshold, typically $100,000, or a certain numerical threshold. 200 is a common threshold. A lot of states have thrown out the number of transactions test and just go with the straight sales amount. For income taxes, States are aggressively pursuing income taxes. The protections provided in the 1950s by Public Law 86272 continue to erode. In other words, you can have no physical assets in a state, and states are increasingly successful in taxing income from out-of-state filers anyway. For example, states have successfully taxed businesses with only intangible assets, such as trademarks, producing in-state income. A big example of that was here in Iowa, where the Iowa Department of Revenue successfully taxed KFC as a result of its franchise income from franchisees in Iowa. It didn't have any physical assets, but it earned assets from basically leasing its trademarks and trade secrets to Iowa franchisees, and so Iowa successfully taxed KFC under the income tax rules. Other states are asserting income tax when sales exceed a certain level. Most prominently California. Hawaii asserts income tax on sales as low as $100,000 in state. Other states have even lower thresholds, particularly if their tax is a gross receipts or franchise tax like Nevada or Texas, where you have no Public Law 86272 protection at all. If you have sales in a lot of states and you haven't looked at your state tax situation recently, you've just been doing the same as last year, you may have a lot of vulnerabilities due to the change in the nature of the tax system for state taxes over the last 10 years. And it would be a good time to contact the Eide-Bailly SALT Group, State and Local Taxes, to determine whether you have exposure in these states. And if you do have exposure, there are ways to limit it through the so-called voluntary disclosure program. You can anonymously come in from the cold, come in with an agreement, then finally reveal your name after the state has agreed to waive penalties and limit the years that you go back. If you're not filing in a state and you don't do voluntary disclosures, then you never start a statute of limitations running, and states can go all the way back to year one to collect back income taxes or sales taxes from you. So always a good time to call John Gupta at the Eide-Bailly National Tax Office SALT team. Okay, now we're going to wrap up with some more individually oriented but business-related tax savings opportunities. This is the most basic tax advice for all individuals, and one that is just all the time missed, and people leave money on the table with this. Take advantage of your opportunities to use tax-deferred accounts. Maximize your 401k deferrals. You're taking money from one pocket, putting it into another pocket. It's still your money, but it's not taxed currently if you're deferring it under a non-Roth thing, or you're taking it from one pocket and putting it to the other if it's a Roth 401k, and you're making the income from that permanently tax exempt forever. It's, well, redundant, but you really should be maximizing your 401k. If you're eligible, you should be maxing out your health savings account contribution. You can use it now to cover current year savings, or you can use it later. This is one of the few individual tax planning opportunities that has no high income phase out. And if you're not using it, you are almost literally leaving money on the table. Contribute to an IRA. Even if you can't deduct your IRA, and many taxpayers cannot, it still can make a lot of sense, because at the very worst, you are getting a tax deferral on your investment income. Consider other retirement vehicles, which we'll get to. And if you have children, grandchildren, nieces, nephews that might go to college someday and you want to help them out, Section 529 plans are a great opportunity to build up tax-deferred college savings. Also, a number of states offer current tax deductions for contributions to these plans. Traditional IRAs are deductible for taxpayers without another retirement plan. The deduction phases out for taxpayers who do have retirement plans. Non-deductible contributions are permitted up to the annual IRA contribution limits if the deduction is phased out, and the non-deductible portion of an IRA contributions come out tax-free when you withdraw the funds at retirement. This slide shows the phase-out range for IRA deductions based on different filing statuses, what income levels they start to phase out. This is also available at irs.gov. Roth IRA contributions are not deductible. However, qualified distributions are tax-free. Non-qualified distributions are taxed similarly to withdrawals from non-deductible traditional IRAs. Qualified distribution is one made after the 5-year period, beginning with the first tax year for which a contribution was made to the IRA set up for your benefit, and the payment is made on or after the date you turn 59 and a half because of disability, to a beneficiary or to your estate after your death, or for a first-time home purchase. Roth contribution, the ability to make those contributions phases out at higher income levels than for the traditional IRA deduction, but they do phase out eventually. So if you're at the higher income levels, you may not necessarily get to make a Roth contribution, but you can make an IRA contribution by the back door through the so-called backdoor IRA contributions. By making a contribution to a non-deductible traditional IRA and converting them to a Roth. While some commentators have challenged it, the IRS has not. Beware though, if you have an existing traditional IRA that has earnings on it since you've made the IRA contributions, then you will have some tax to pay if you make backdoor IRA contributions. So if you already have a traditional non-deductible IRA or a rollover IRA, you may find that the Roth IRA doesn't work quite so well. The annual IRA maximum contribution limits are the lesser of your compensation income, or $6,000, $7,000 if you're 50 or older by the end of 2022. Health saving accounts for qualifying taxpayers and above the line deduction isn't allowed without income limits. You can make non-qualifying withdrawals after age 65 or upon death or disability in their tax-like IRA withdrawals. Or you can withdraw tax-free to the extent that you have had qualifying medical expenses since the inception of your HSA that have not been reimbursed by insurance or by prior HSA distributions. 2022 limits are $3,650 for single coverage, $7,300 for family coverage. I'll briefly mention solo K plans. These are great for single employee S corporations or self-employed taxpayers. These are single participant 401k plans that can allow up to a $61,000 deduction if you're age 50 or older and you have enough qualifying income. Has to be set up by the end of the tax year, but funding for amounts other than the elective deferral portion can be delayed until the return filing date. However, it does have more difficult filing requirements than some other plans, such as SEPs. SEPs are the last minute friend of gig workers. They can be set up as late as a return filing deadline for income earned the prior year. Easy to set up, no employer 5,500 requirement. They're very inflexible. No discrimination allowed among qualifying employees. Or, and this is something that's becoming more and more popular, you can use a defined benefit plan, such as a cash balance plan, to really turbocharge retirement deductions if you are a taxpayer of a certain age. And we are coming to the end of the presentation. And with that, I'm going to take a look at the Q&A since we're running out of time here. The first question is the ARC quarter comparison with 2019? It's with the corresponding quarter for the prior year. Yes, it should be a 16,000. Another person asked whether it was 15,000. That is correct. That is an outdated number. That's 16,000 per donor, per donee for 2022. A couple people have pointed that out, and that is absolutely correct. And can unused 529 plans be kept in 529 plans even after kids completed college and then name grandparents' kids as beneficiaries in the future? That is absolutely so. You can do that. There is a lot of flexibility to change beneficiaries. One child can graduate, you can transfer it to the benefit of a sibling. So yes, there is a lot of flexibility there. And actually, sometimes people, when their kids graduate, say that we'll take it out for their own benefit to take classes in retirement. So it's a very flexible plan. With that, I hear the courthouse clock ticking 1 p.m. And correct me if I'm wrong, Amy, but I believe our time is up.
It is. Any final thoughts there?
There's a lot more individual planning than I have covered here. And I do encourage you to contact your Eide Bailly representative. The sooner you start your year-end planning, the better. It's a lot easier to accomplish a lot between now and year-end than in, say, the last 2 weeks of December. So with that, I thank you, and please feel free to contact me or your Eide Bailly Tax Pro with any further questions.